Well, good morning. I'm Jagender Rana. We're discussing today 100% FDI limit in insurance. 100% FDI limit in insurance. The Finance Ministry has released a consultation paper proposing to raise the foreign direct investment limit in the insurance sector from 74% to 100%, ahead of the likely introduction of a bill to this effect in the ongoing Parliament session. So the Department of Financial Services has sought stakeholders' comment on the proposed insurance laws amendment. The winter session of Parliament will conclude in the December itself, and the bill would be introduced to this effect in the next session now. Because the department said the proposed amendment aims to ensure accessibility and affordability of insurance for citizens, foster the expansion and the development of the insurance industry, and streamline business process. So, in this regard, a comprehensive review of the legislative framework governing the sector has been conducted in consultation with the Insurance Regulatory and Development Authority of India. The proposal includes raising the FDI limit in Indian insurance companies from 74% to 100%, and enabling an insurer to carry on one or more classes of insurance business as well as activities related or incidental to insurance. So the proposal further mentioned that the requirement of net owned funds for foreign insurers is also proposed to be reduced from rupees 5,000 crore to rupees 1,000 crore. Also, IRDAI is being empowered to specify lower entry capital, not less than rupees 50 crore for underserved or unserved segments on a special case basis. So microinsurance firms likely to benefit if capital requirement is lowered. Means the government is expected to introduce the insurance amendment bill in the budget 2025 session now, aiming to allow 100% FDI, that is foreign direct investment in the insurance sector. This allows the 2021 reform that raised the FDI limit from 49% to 74%. Now, among the key proposed amendments, the bill aims to bring significant changes to the insurance industry, including 100% FDI approval, because foreign insurers and financial firms will be allowed to operate independently in India. Foreign insurers and financial firms will be allowed to operate independently in India if the 100% FDI approval is given. Then the composite licenses. Insurers will be able to offer life and non-life policies through a single entity, streamlining operations. And agents' flexibility. Insurance agents may be permitted to sell products from multiple companies. Insurance agents may be permitted to sell products from multiple companies. And reduced capital requirements. Foreign reinsurers Minimum funds may decrease from rupees 5,000 crore to 1,000 crore for insurers. Micro-insurance firms, anti-capital may be reduced to as low as 50 crore for underserved areas subject to approval by the Insurance Regulatory and Development Authority of India. However, higher capital thresholds may apply for composite licenses compared to separate licenses for life and non-life insurance. So the reforms aims to enhance insurance accessibility and affordability, attract more capital to expand the industry, improve insurance penetration which stood at just 4.2% in India in 2021 compared to the global average of 7%. So India's insurance market includes over 24 life insurers and 26 general insurers, 6 standalone health insurers, and 1 reinsurer, General Insurance Corporation of India. So with the new amendments, some foreign players may exit partnership with Indian companies and re-enter as independent entities, while others may diversify operations. So the sector is currently dominated by life insurance, which constitutes 76% of the market. Globally, life insurance accounts for 43.7% of total premiums. So with non-life insurance contributing 56.3%. The proposed reforms aims to balance these segments and foster industry growth. Finance Minister is likely to announce these amendments in the upcoming budget speech, signaling a transformative era for Indian insurance sector. So the Union Finance Ministry has released a consultation paper proposing to raise the FDI limit in the insurance sector from 74 to 100%. The FDI limit in the insurance sector was previously increased from 49% to 74%. So this increase is now expected in the budget session of 2025. And that would be good for the insurance industry also, because number of amendments are expected which are online for approval. So the FDI is increased to 100%. Foreign insurance companies may transact insurance business independently. The government is preparing to introduce major reforms in the insurance sector by allowing 100% foreign direct investment in insurance companies. So these changes are part of the upcoming insurance amendment bill, which will be presented in the next budget session. If passed, the bill will mark a significant shift in India's insurance landscape, opening the door for global players to enter the market and enabling individual agents to sell policies from multiple insurance providers. This move departs from the current rule, which limits agents to a single association per type of insurance, life or general. So currently the FDI cap in the insurance industry is set at 74%, covering life, general and health insurance sectors. The industry currently consists of 24 life insurance, 26 general insurers and 6 standalone health insurers and 1 reinsurer. So by raising the FDI cap to 100%, the government aims to attract well-capitalized global insurers capable of underwriting policies in this capital-intensive sector. Additionally, the bill will provide insurance agents the flexibility to sell products from multiple companies. So effectively lifting the restrictions that currently limits them to working with one life insurer and one general insurer. Though some agents have found ways around this rule by registering family members as agents for different firms. The proposed changes would normally or they formally allow agents to offer a broader range of insurance products. These reforms are part of a broader strategy to boost insurance penetration in India, which remains low at about 4%. So the policy seeks to increase the number of insurers and provide consumers with a wider selection of products while also making it easier for agents to navigate the market. So in addition to raising the FDI limits, the insurance amendment bill is expected to ease certain regulatory requirements, including those concerning company directors. Furthermore, the Insurance Regulatory and Development Authority of India has proposed allowing insurers to hold composite licenses, which could benefit firms like Life Insurance Corporation of India, enabling them to enter the health insurance market. The government is also considering relaxing solvency requirements, which would free up capital for insurers to enhance their operations and expand their offerings. So the question is, the penetration is always a challenge for the Indian insurance industry. And this is ranging between 4 to 4.2% only, maximum. Now this has to be increased because the object is that insurance for all should be there by 2047. So the IRDAI is in the favor of allowing 100% for direct investment in insurance intermediaries. In addition to insurance brokers, the regulator is of the view that if insurance brokers can be allowed, then the other insurance intermediaries like aggregator and third-party administrators may be considered for the same relaxations. And now it is the turn of the insurance companies, where there is no fear, because insurance industry is a capital-intensive industry. Insurance industry is a capital-intensive industry. Here, more and more capital is required. If the more and more capital is there are 100% chances of increasing the insurance penetration in the country. Because life insurers bet for 100% foreign investment. And they have sought 100% foreign direct investment in the sector through the automatic route, which can help the sector attract capital of rupees 40,000 to 60,000 crore. Because India has received nearly 30,000 crore worth of FDI in the private sector insurance firms since 2015, when the government had increased FDI limit from 26 to 49%. So in a detailed presentation to the IRDAI, life insurance companies pitched for 100% FDI limit in the sector. Because investment under the automatic route does not require prior approval from the government. The insurance regulator has invited views from all the companies to increase the FDI limit. The government will examine suggestions of further opening of FDI in aviation, media, visual, gaming, and co-make an insurance sector in consultation with all the stakeholders. So the life insurers said the government should allow both the options, FDI and foreign institutional investors in opening the insurance sector to 100% via the automatic route. This will give the insurance companies an option to decide on which route they would like to take, FDI for FII or a combination of the two. To increase the limit to 100%, the insurers said in the letter. So the increase in stake from 26 to 49% in 2015 led to an increase in total premium income of the Indian life insurance sector from around rupees 3 lakh crore in 2014 to around 4.5 lakh crores in 2018. The total premium income growth for the private sector during 14-15 and 15-16 was 14% each, while in 17 and 18 it was 17% and 19%. So further increase in FDI to 100% is likely to grow the Indian life insurance or general insurance sector at much faster pace. So in the past, the increase in FDI to 49% helped in increasing assets under management for the private life insurance players from rupees 1,07,225 crore in 2014 to 2,54,461 crore in 2018. So the expectations are very high. Thank you very much.